Hey everyone, welcome back to Corporate Decoder, the place where we unravel the complex world of business, one filing at a time. Today we're diving deep into Synergy CHC Corp latest quarterly report, and let me tell you, there is a lot to unpack, especially when it comes to their finances. Think of it as a treasure hunt for financial insights, and we've got our picks and shovels ready. Also, if you love getting these insider looks at company performance, make sure you subscribe and join our Discord community linked below. So Synergy CHC Corp has just dropped their quarterly report, a 10Q filing that gives us a peek into their financial health for the period ending the 30th of September 2025. This report is crucial because it tells us how the company is performing not just in the short term, but also hints at its longer term trajectory. Alright, let's get straight to the heart of the matter, the financials. When a company releases a report like this, the numbers tell the real story. Looking at their balance sheet for the 30th of September 2025, we see they have total assets of about $20.7 million. That sounds pretty solid, right? But here is where it gets interesting. Their total liabilities are almost $29 million. So they actually owe more than they own, meaning they have a stockholders deficit of over $8.2 million. Think of it like this. If they were to sell everything they own, they still wouldn't be able to pay off all their debts on that specific day. This is a big red flag that investors always keep a close eye on. Despite this deficit, their cash and cash equivalents have grown to over $1 million from about $687,000 at the end of 2024. That's a good sign of improved short-term liquidity. Now let's talk about making money. For the 3 months ending the 30th of September 2025, their total revenue was just over $8 million. That is up from about $7.1 million in the same period last year. That sounds like growth fantastic, but dig a little deeper and you'll see their product sales, which is their main business, were exactly the same as last year, about $8 million. The increase in total revenue actually came from a license revenue of $2.9 million for the 9-month period, which is a one-time or specific deal, not necessarily a sign of consistent product sales growth. Their gross profit, which is the money left after paying for the cost of making their products, for the 3 months ended the 30th of September 2025 was about $5.7 million. That is a good jump from about $4.8 million last year, meaning they are keeping a larger piece of the revenue pie. This is largely because their cost of sales stayed pretty flat even as their revenue increased. For the 9-month period, their gross profit jumped from about $17.1 million to over $18 million, and their gross profit margin improved from 70 to 74%. That's a very healthy improvement and shows they are managing their production costs well. However, when you look at their operating expenses, things start to change. For the 3 months, selling and marketing expenses went up a bit, which is normal. But their general and administrative expenses, the costs of running the business behind the scenes, jumped from about $1.2 million to over $1.6 million. The report says this is due to public market expenses, basically the cost of being a publicly traded company for the 9-month period. These gadget expenses have risen significantly too. This increase in expenses combined with higher interest expenses, which we'll get to, ate into their profits, their net income. The actual profit they made for the 3 months ending the 30th of September reported at $125,327, which is a big drop from over $783,000 in the same period last year. For the 9-month period, their net income was about $2.5 million, up from about $2 million last year. But that looks good only because there was a gain on settlement of loans of over $2.1 million. Without that, their underlying operational profit decreased. Now, let's talk about debt. Their interest expense is eye-opening. For the 9 months ended the 30th of September 2025, interest expense ballooned to almost $4.4 million. From about $2.6 million the previous year. This is a massive increase fueled by new loans and other financing. For the same 9 months, the company took out new loans totaling over $18.9 million, while also paying back significant amounts of existing debt. This high interest burden is a real strain on their profitability. This brings us to cash flow. For the 9 months ending the 30th of September 2025, the company used about $3.2 million in operating activities. That's a big increase from using about $1.4 million last year. This means they are spending more cash just to keep the business running on a day-to-day basis. A big chunk of this is due to changes in their working capital, like increases in accounts receivable and prepaid expenses. meaning they are owed more money and have paid out more for future expenses. On the financing side, they brought in about $3.5 million in the 9 months of 2025, compared to about $900,000 in 2024. This is mainly from issuing stock and taking out new loans, as we've already seen that heavy reliance on debt. They also paid off significant portions of their notes payable, showing a constant cycle of borrowing and repaying. Let's dive into these notes payable. The company has various loans and the numbers are quite large. For example, they took out a $17.5 million loan in May 2025. The interest rate on this loan is quite high, around 12.78%. They also had a massive repayment and restructuring of a $10 million loan early in 2025. It is clear that managing this debt load and interest payments is a critical challenge for Synergy CHC Corp. Now, about their stock, as of the 30th of September 2025, they had over 11.4 million shares issued and a little over 11.2 million shares outstanding. They've had a lot of share activity this year, issuing stock for consulting services to settle debt, and they even had a public offering in August 2025. Raising about $3.8 million in net proceeds that they plan to use for working capital. This indicates a strategy of using equity to shore up finances and manage debt. The company reports having one operating segment focusing on nutraceuticals. They break down their sales by region and channel. In the US, sales were down for the 9-month period, but sales in foreign countries, mostly Canada, were up significantly. Online sales are also growing nicely, while retail sales have seen a slight decline. The company is heavily reliant on a few key customers and suppliers, making them vulnerable to shifts in those relationships. Interestingly, the report also disclosed that their disclosure controls and procedures were not effective. This means that information required to be disclosed might not be recorded, processed, or reported in a timely manner. This is a pretty serious concern for investors who rely on accurate and timely information. Overall assessment of Synergy CHC Corp. Overall assessment of Synergy CHC Corp. So what's the big picture here? Synergy CHC Corp is in a challenging financial position, while they are growing revenue and showing improved gross margins in their core products. They are heavily reliant on licensing deals for top-line growth and seem to be struggling with high operating expenses and a massive interest burden from their debt. Their significant stockholders' deficit and the ongoing need to raise capital through stock issuance or new loans suggest they are constantly trying to keep their head above water. The effectiveness of their internal controls is also a noteworthy risk. Notable risks and opportunities: the company's strategy of balancing organic growth with strategic acquisitions is understandable, but their current financial structure makes aggressive expansion risky. The opportunity lies in their growing online sales channel and potential international expansion. The significant concentration of revenue from a few customers and suppliers presents a considerable risk. Conclusion: in conclusion, Synergy CHC Corp is a company in transition facing significant financial headwinds, while there are signs of operational improvements in gross margins. The overall picture is clouded by high debt, increasing operating costs, and potential control weaknesses. Investors should proceed with caution and closely monitor their ability to manage debt and generate consistent, profitable growth outside of one-off licensing deals. The recent stock offering and ongoing debt financing highlight a continuous effort to stabilize their financial foundation. Alright, that is our deep dive into Synergy CHC Corp's latest financial report. What do you think about their strategy and financial health? Let us know in the comments below if you found this breakdown valuable. Give this video a thumbs up and subscribe for more, and definitely check out our Discord community linked in the description for more in-depth discussions. Thanks for watching Corporate Decoder, and we'll see you in the next video.